CF Benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
I'll kick things off with an introduction. So welcome everybody to CFB Talks Digital Assets Live. This is our weekly conversation on everything digital assets, macro, and also top news, brought to you by the leading index provider in the space. My name is Gabe Selby. I'm the head of research at CF Benchmarks. Joining me as always, we have Mark Pilipczuk, our research analyst at CF Benchmarks, and Tomas Perfumo, the chief economist at Kraken. Our special guests this week include Wang, product manager at CF Benchmarks, and John Todaro, managing director for crypto and HPC and AI research at Needham. John, it's an honor to have you on our X Space. I think since you're a first-time participant, it'd be great to just have you give a brief introduction of yourself as well as Needham, so the audience can know what you all are about.
Yeah, of course. Well, thanks for having me on, and happy to be here. So I guess I'll start with Needham. Needham is a full-service investment bank, mostly focused in North America, so the U.S., Canada to an extent. We're headquartered in New York City, but we do have offices all over, with our main offices Boston on the West Coast, obviously New York, and then down in Miami. My focus in particular is on the crypto public equity names, and then also the powered AI infrastructure. So at this point, almost all the Bitcoin miners, or really all of them, at least all the ones I cover, have pivoted towards HPC and building data centers for AI workloads. So that has become a large part of the universe I work with and cover. And then that also dovetails a little bit with, I'm sure we'll get into this, neo cloud businesses like CoreWeave, which I also cover. That's been kind of my coverage universe and framing. I would say most of the clients I'm talking with are your big institutional investors. So I think your large long onlys, and then also the hedge funds that traffic in the space.
I'm really excited to get your takes on all this, because in one sense, one part of the asset coverage that company coverage that you're doing is really being impacted right now with what's going on in macro, what's going on in markets, and the other side is really kind of benefiting. We're seeing like a lot of risk appetite, a lot of sentiment for the other side as well. So I'm really curious to get your take. To kick things off, I just want to kind of go over a quick data check. Crypto's moved pretty hard overnight. Bitcoin's, I think, trading around 63,500. That's down more than 13% on the week. It's about roughly half off from its October high. And we're on, I think, the third day of kind of like increased capitulation. And right alongside that, we have our own implied volatility gauge, the CF Bitcoin Volatility Index, otherwise known as BVX. It's gone vertical. So it's bottomed around 31.6 on May 31st. It's now sitting, I think, around 50, but it spiked up to 54 up on yesterday when we saw that sell-off kind of acceleration. So we're seeing a lot of bid for protection. When we look at the rest of the tape, 2 years at 449, the dollar is still cyclically strong. Equities are starting to kind of roll off a bit, and I think that's after Broadcom's announcement. So John, we'll probably get some of your views there when we talk about the equity space and earnings and everything like that we've seen. But I want to kind of kick things off as we usually do with the macro picture. And so we'll start off with Tomas here, our chief economist. John, Jen, always feel free to jump in before we kind of go around to kind of your specialized topics. But Tomas, it seems like the market's really starting to kind of come to the realization that there's potential for a Fed rate hike. I don't know what the percentage odds are right now for a rate hike in 2026. Is this a tail event that's being priced in, or is it still kind of being underpriced?
I'm looking at the CME Fed Watch right now. It's about a 50% chance that's being priced in right now that we get either one or two rate hikes by year-end 2026. And so certainly I think the market is pricing in an expectation that it can happen. What's interesting to me is that my personal opinion on the rate outlook is that it's almost entirely driven by whether we get a very quick resolution to the U.S.-Iran conflict and how oil markets will read into whatever announcement is or is not made, right? So if you see a resolution or a deal signed tomorrow and oil markets quickly price down, that would lead me to believe that we might actually have an argument, or at least Kevin Warsh would have an argument to make that on a forward-looking basis, you should start taking action now, acknowledging the fact that monetary policy lags, and you should look through this kind of shock event. And so the market, like I said, it's kind of like 50-50, either we hold or we hike from here. And I think that really reflects the binary uncertainty around whether we keep prolonging this conflict or we get a deal signed any day now.
So, with regards to the deal, I think some of the few sticking points that we're still trying to work out, at least from my seat, is that they're trying to, I think, understand what this post-conflict Iran will look like. Will they have access to, their or will they keep their uranium stockpiles, thus increasing the risk of development of a nuclear weapon? Also, who's going to control the Strait of Hormuz? I think these are two major sticking points. And to me personally, it does feel like, despite some of the rhetoric that you get through the administration, despite some of the hopeful messages about, this negotiating progress coming forward, these are kind of big hurdles to clear, right? So I guess is this something that the Fed, in your opinion, Tomas, should continue or try to find a way to kind of look through that Hormuz premium that you're referring to?
I think they're trying to look through it. I mean, even Jerome Powell stated this a couple of months ago that is the classical expectation, is that when you have a shock like this, you look through it because a year from now, when you start lapping these higher comparables, the percentage inflation just isn't going to be as dramatic, and so it basically corrects itself after a year. The difficult part with oil in particular is that, or any commodity really, once you start hitting like an inflection point, it can really squeeze. And so the question right now is you have global inventories being drawn down. Do we get to a point where oil at $90 a barrel is actually really underpriced and we shoot up to like 150? In which
Mhm.
case it's really hard to make the call right now, this moment, until you feel like you have a good case for whether we're reaching an inflection point or a squeeze point. And I think they just much rather wait, even like a couple more months before trying to make a call like that, because it can change on a dime.
Yeah. Eh, John, on your side of things, I know you've kind of you're more specialized into these industry groups. How do you see kind of this macro picture with potential Fed rate hikes impacting some of the names that you cover?
Yeah, I would say on the crypto specific names like the Coinbases, the Circles of the world, they do have a more direct impact. One, macro always has a little bit more of an impact with Bitcoin and crypto assets. Is one component. Circle then has that direct impact from interest rates, right? And to some extent, it's a positive, but because higher interest rates, they can earn more on their reserve income on USDC. But then the thinking is that the activity within stable coins might be lower too. So for Circle, it's a little bit more muddied. For Coinbase, I think it's a little bit more direct, that would be a negative impact. And then on my data center names, the HPC AI names, which is where most of these Bitcoin miners are now, I would say much of the market doesn't even really look at the Bitcoin business they have, right? Some of these do still have Bitcoin on the balance sheet. And with the Bitcoin sell off, there is that direct negative impact to valuation. But almost every investor is reading through that and seeing what value is there in the data center business. And part of that reason is because almost all of the miners we cover are going to be out of Bitcoin mining in 2 years' time. So if
Wow.
you are thinking about valuation, looking out to like 2029, for instance, a lot of investors have no Bitcoin business for these miners. They're simply looking at it off the data center business and what those margins look like, what that EBITDA looks like, and it truly is night and day difference for the most part, right? At Bitcoin mining, a lot of these guys have been kind of near break evens to mine Bitcoin, so you have a very slight EBITDA margin. Whereas HPC, high performance compute, if you're doing a triple net lease, you're pretty much at 100% margin there, at least NOI, net operating income. So, I think investors are kind of looking more through that. And if you can pull it off, it's a big win. And
Yeah.
obviously AI is super topical and there's a lot of capital going towards it. So there's a lot of buyers out there for that piece of the puzzle. Whereas Bitcoin mining, I guess to summarize, I would say most of those names aren't even all that directly impacted by some of the broader macro and Bitcoin components. Those names have much more company-specific events. And an example of that would be, even if we're in a little bit of a macro risk-off environment, if one of these names signs some big lease, the stock's going to be up, right? And it's going to be up by quite a bit because everyone is so focused on the lease catalysts that have been occurring, and the economics of those leases, and a little bit less so with either one, the price of Bitcoin, or two, the broader macro.
Yeah, I mean that's really I think like a headline grabbing statement that you said earlier about how in a few years we're going to see a lot of these miners just completely exit the industry. So I guess is Bitcoin mining, in your opinion, is it a dying business, or is this something that we, in the industry, should start to kind of really think hard about of what's going to take its place?
It's funny. One, yeah, I'm surprised. The media and others in crypto have not drawn more attention to it than it's gotten, because all the 2 years ago when we talked about the largest Bitcoin miners, many of them were these public companies here in the U.S. That is very much not going to be the case in 2 years. They will be mining for several of them zero Bitcoin, right? They will have their full operations wind down. And so I don't know if that's gotten as much attention as maybe it should. At the same time, I don't think it's really cataclysmic for the network. And it's the Bitcoin network also self-corrects a little bit. So if everyone leaves because you're getting a much better margin in HPC, well, your Bitcoin mining margins then get a little bit better, right? I think the more concerning piece is just when you're a public company, there is a difference in multiple. And the multiple investors are willing to pay for an AI business because they view it very growthy and stable margins. They're willing to pay a lot more than Bitcoin mining. So I do think for public companies, it makes sense to pivot away from Bitcoin mining. If you're private, maybe less so, or if you're in a geographic location where you really can't build an HPC data center anyway, then I think Bitcoin mining makes a ton of sense. So I don't think everyone in the network pivots away, but I think uniquely for public companies in the US, where there is the fiber and the infrastructure to do HPC data centers, it makes sense to push more into them. But if I'm a private Bitcoin miner, or I have a private data center operation outside the US, and there's not really the abundance of fiber in my region, I would probably continue to mine Bitcoin. And if all the public guys in the US, which is about 20-25% of the network, if they all migrate off, then my margins get a little bit better anyway. So if I'm a Bitcoin miner elsewhere, this might be kind of the worst of it for me, assuming Bitcoin price kind of stays flat or goes up from here.
For
Yeah.
those Bitcoin miners that are moving over to HPC, are they running into any issues when it comes to sourcing the actual GPUs, memory, and all the servers and everything? Or are they paying any kind of premium on that stuff?
But most of them pursue a co-location model where they're not acquiring the GPUs. That is, a customer is coming in and bringing their own GPUs. The only exception to that is IREN, which definitely, a lot of folks on X and elsewhere care on IREN. IREN's a bit different, but IREN has a very close relationship with Nvidia and some of those suppliers. So IREN's kind of in the same camp as the other cloud operators are, where you have status with Nvidia and you're able to get those. There's always some question of supply chain. I think there's always a piece of, hey, you're not getting GPUs and networking components and all that as fast as maybe you would like. But that's just kind of consistent across the industry. Everything we've seen, IREN has a very good relationship with Nvidia. I'm sure you guys saw the recent kind of partnership and investment between Nvidia and IREN. So from that standpoint, not really seeing the Bitcoin miners specifically impacted. But as I mentioned, it's IREN, it's a few other smaller ones. Most of that Bitcoin mining segment that's pivoted over, they are pursuing a colo model where they're not sourcing and procuring the GPUs.
Yeah. And then on the infrastructure side, like the electrical infrastructure or getting the power hookups to everything, are they running into any issues there, or is that a point of friction for them?
That much more is. I mean, the big question, part of the reason the Bitcoin miners had an advantage to begin with is it takes very long to get power in this country. There are certain grids where it's going to take 4+ years, right? And even in ones that have historically been a little bit more kind of open, like ERCOT, there's a big question right now about how much capacity ERCOT's going to deliver to you. Right now there's ERCOT batch processing guidelines that are ongoing, and that's the big question is for new power you're looking to get, how much of the requested power are you going to get? How much of it is firm? There is a piece of that. What I would say is the sites that these miners have already have, they've had an advantage because they were in the queues early, the interconnection queues, or they already took a bunch of power. And this was because, if you look back 5 years ago, there wasn't a ton of demand for power in super remote locations in the US. There was demand from the Bitcoin miners. It made sense for them to go out there, but not really other data center workloads. But when you came up with AI, specifically training workloads, you could do them in remote locations. Latency wasn't that big of a deal, and you needed power density, and you needed large single clusters. So, a 250 megawatt site for Equinix and Digital Realty historically was kind of not what they were pursuing. The Bitcoin miners pursued that for Bitcoin, and it just so happened that AI training workloads kind of have some of those similar requirements. So then these large sites in remote locations became attractive, and so that was the main angle for these Bitcoin miners to be so successful there. I think the question you're asking more so is moving forward, can you consistently get this power? And that is a bit more of a question mark. I would say some of these guys have done a very good job of adding new power, but it's definitely one of the biggest questions we get is, can you consistently add power when there's so much demand from so many different operators now?
So, in summary, we should expect kind of a bifurcation as far as in the Bitcoin mining space between like the U.S. publicly traded historical miners and perhaps the smaller private ones. Those ones that are publicly traded, or you expect them to, or they're announcing that they're going to be shifting away completely from Bitcoin mining and become kind of like these industry landlords for the AI build out, for the hypercompute build out, and the ones that will be left will be kind of more niche, more specialized.
Yeah, I would say, and there's some exceptions, right? So like American Bitcoin, which is public, is obviously going to remain focused on Bitcoin mining. That is a key part of Canaan, the Bitcoin machine manufacturer. They do some Bitcoin mining. They're going to remain focused on Bitcoin mining for the most part. So there are a couple exceptions, but yeah, I would say, I mean, I would even say your private data center operators in the US, though, if they have a Bitcoin mining site that can be converted to HPC, they're going to pursue that. And we talk to a lot of the private data center operators too. If they want to go public, and a lot of them are pursuing the same HPC strategy that the public ones have. So
Yeah.
it's not necessarily just if you are public, but more so if you have plans to go public, which is simply, look, if you have a data center that can support AI workloads, I think most of these operators who are sitting on that think it's very much just leaving money on the table to continue mining Bitcoin and not go after those AI workloads. I think where it's different is if you have a site that is super small in terms of megawatt capacity, so you're never going to sign a hyperscaler. And if you don't sign a hyperscaler, it's going to be hard to raise financing to cover the capex to actually build that out. So that's one component where maybe they would continue mining Bitcoin. Or if you're in a region where there's going to be a lot of other capex that's necessary to support it. So say you're in a region with no fiber and maybe you're mining where you send Starlink up, that might make sense to kind of just continue with Bitcoin mining. But if you're in anything that's considered a fairly attractive area to run a data center operation, and you're sitting on like 150 megawatts, and you have the land, there's going to be a large investor base that's going to believe that you can go sign a hyperscaler, and that you should pivot to HPC AI. And when those investors get on board, I mean, the operators go along with it, right? Because you're talking about becoming a much larger company. You're talking about having all the largest institutions of the world buy your stock. And
Yeah.
so I think, and then also you're just getting better margins and all that. So less so just a bifurcation between private and public, more so if the sites are suitable, unless you have like a diehard conviction Bitcoin, you're going to go towards HPC. And we've even seen cases where activists get involved. There's just been such a push from the market that even if the management team maybe prefers Bitcoin mining, there's such a push from investors to go down HPC AI. And then they get involved with the board, and the board's pushing it, that it's very hard to kind of stick with Bitcoin mining if your sites are suitable for HPC.
Yeah, I know the economics have always been challenging, especially, post halvings, but it does seem to me like when you have this rotation and all this exodus out of the mining space, just like within other cycles, there's potential for, opportunities for people for things to become attractive again, maybe for people to maybe enter new capital to come into Bitcoin mining. But yeah, like you're saying, it seems like with the way the market sentiment is, where the appetite for allocating capital is, it's becoming, just a no-brainer for a lot of these miners to pivot. I want to kind of also pivot and talk a little bit about the crypto equity space. I know, Tomas, you've done a lot of research on MicroStrategy, covering, its persistent bids, talking about stretch. We recently had a headline where MicroStrategy sold Bitcoin for the first time since 2022. Now, it was only 32 coins, so it's kind of like a small potatoes compared to their Bitcoin stack. And but that kind of got lost in the narrative, I think, where it was used to cover their dividend for the stretch dividend. And now you're seeing a lot of headlines, I think, starting to kind of come out with its unrealized losses, I think, mounting over $10 billion underwater. So I guess I would be curious, Tomas, you've tweeted about this, you've talked a lot about this, the MNAV, where we're sitting at right now. What's the is there any reflexivity run for things to kind of like pick up steam, or are we starting to settle in here?
I think we need to digest a little bit. You know, I'm gonna take this up to like a meta level. MicroStrategy is a capital markets vehicle, right? Like they're not a price sensitive bidder for Bitcoin. It's like very straightforward. If they can issue security in an accretive manner, they'll issue it and then they'll go and deploy that usually in the same week. That's what they've been doing for going on 5, 6 years now. And as every capital markets vehicle, and again, this is not exclusive to MicroStrategy, you can look at REIT space, for example, BDCs, etc. You're going to be subject to just like the macro capital markets picture. And in my view right now, the thing that's been creating some unease over the last month really has been this prolonged US-Iran conflict. You have a widening of credit spreads, not just in private credit, but sovereign debt yields rising to multi-decade highs on the long end of the curve. And now you have this massive liquidity event with SpaceX, planning a record $75 billion raise next week. It seems like everyone's pulling every stop they can to create enough distribution to reach like enough liquidity for this offering alone, this single offering. I'm talking about waiving certain rules for index participation, allowing retirement funds to participate, having every single bank you could possibly list on that prospectus. And I think that's indicative of the fact that there's a tightness in capital markets of the needs from the AI and the hyperscaler and that narrative driving capital from other parts of the economy and other parts of the market. And crypto is particularly sensitive to liquidity conditions in the capital markets. And we're in a situation where there's a lot of demand for capital and not a lot of places to source it. And the Fed is not growing its balance sheet. And so it needs to rotate from somewhere. So this whole situation with MicroStrategy, with Bitcoin, I think straightforwardly is a reaction to this like tight capital market we're in. We've seen ETFs sell 13 consecutive days in a row. The prior record was, I think, 6 or 7, possibly 8. So we're almost double that at this point. And yeah, I think the 32 Bitcoin sale, symbolic, poorly timed in hindsight, but they couldn't have known the drawdown we were going to see from the ETFs 2 weeks later. And I really think that people are kind of trying to find a scapegoat for it. And so my opinion on the strategy side, anyway, on the MicroStrategy side, is I think they probably just need to sit and wait a little bit and just have the market digest. And we need to see a few days of just pauses in selling from the ETFs. And my suspicion is that until we get to the SpaceX IPO next week, it's just going to be a difficult market.
You've had some, I think, really good charts talking about this crowding out effect. And one chart I think I remember seeing was one on DRAM and the flows into like DRAM specific vehicles versus Bitcoin ETFs, right?
Yep.
That
Yep.
is that something, you know, you're kind of, I guess, tying that narrative there with the SpaceX IPO. You're getting a lot of these other alternatives, and I think, you know, one alternative is that we're seeing the front end also kind of price up with potential rate hikes. And of course, Stretch, I think, was ironically uh, marketed as a kind of like an alternative savings vehicle when it was trading at par, offering 11% dividend. But of course, I think, you know, just like anytime the front end starts to reprice up, it really disrupts other things that we consider proxies for savings vehicles, including, you know, Stretch. So the timing of that also, to me, kind of speaks volumes. And John, I want to get your take on the DATs in general. If you have any views that you want to share with what's going on there.
Yeah, first I would say it's a very real and accurate observation that was pointed out with these large IPOs coming. You know, from my seat, even when you're talking to a lot of these large institutional investors, even they're rotating out of certain names in order to have enough capital to participate in these very large IPOs. So you are seeing that, and I do think it's a little bit different from other periods where the capex requirements for many of these guys is so real and significant that you do need to raise a significant chunk of capital. And you're kind of seeing several of them at the same time. And so that very much is a dynamic at play. You know, I think Bitcoin and crypto is sensitive to that, but you're even seeing in other parts. So I do just want to agree with that sentiment. I think that's very accurate. In terms of the other DATs, I think from the institutional landscape, there has been very limited interest. And part of it might be because there's just such a competition for capital right now. I think that's one of it, but it's also there's just other kind of exciting parts of the broader economy, call it that is getting more attention than crypto, and DATs in particular. There has been a push. One, I think a lot of funds would like to see more operating segments within DATs. Right? Can you go acquire a business that has cash flows? That's maybe in the same vertical as the single crypto asset you are supporting. So that's one dynamic. And then two, as we mentioned, you got AI, you got aspects of prediction markets that have been exciting. You've had other kind of areas that are drawing a lot of investor eyeballs, even if maybe it's not necessarily capital, but that they're just kind of focused on, they want to get smarter on. So, when we hold a conference, candidly, if we could just rank it, my AI names, you might get 50 to 70 investor requests to go meet with that company. Or if it's a DAT, it's going to be much, much lower than that, right? So part of it's just, the crypto ecosystem is down a bit and they're kind of less in vogue. But there's also some operating pieces that investors, I think, would like to see the DATs do, to become more attractive again. And that is going out and acquiring more operating businesses, having cash flow and more of that versus, maybe you're generating yield on a single crypto asset, but that's kind of it.
Yeah, that is something that's interesting. I speaking of like generating yield on a single asset, I see across the tape here that the Ethereum treasury company BitMine, of course, that is Tom Lee's, chaired by Tom Lee, is now issuing out 9.5% yield on its new preferred stock. And to your point about having cash flows, they're sitting on a nice stack of ETH that's being staked, generating yield. Do you see that kind of being enough to kind of give them, degree of separation, in terms of, comparing them to other debts that might not have that staking component?
Yeah, so I would say when these are staking, it's definitely helpful versus if you're not generating any yield. At the same time, I would say these institutions in particular want to see something that has a more operating business versus a passive yield that's generated. And so what we've consistently heard is, hey, would love to see some of these guys go out and maybe acquire a company within the vertical they're supporting so they can still support maybe it's the Ethereum ecosystem, Solana ecosystem, whatever it may be, but you have some operating businesses within that umbrella that are generating cash flows and have real customers and a true business there. So it's definitely helpful. But I would say at least in the with the investors we talk with, there is a preference for operating businesses. And look, that might just
That's
also be
interesting.
because we're at the low point of the cycle, right? And so whenever things get this bad, you look for, okay, what's a core operating business that I can support, right? That I know is going to have customers that show up, that I know is going to generate revenue and activity. Whereas on the DAT side, you're just looking at the price of the coin, the yield you're getting, and you're watching that price go down, and it's obviously a little bit more concerning than if there was some stable operating business. So I do acknowledge or appreciate that. I think a part of that push from investors is because we are at the point of the cycle where we are, and Bitcoin's around 63K, and some of these assets are making close to new lows for this cycle. So I do acknowledge that part of that though might just be kind of getting pushed around by the market and the environment.
Yeah, we're going to jump over to that market environment next. I think it's a good time to segue. Obviously, vibes are very, very low now. Mark, over to you. I want you to name probably the strangest chart in crypto. What's really sticking out as far as a name that's really, I think, doing well right now?
Yeah, the only thing that's really been able to separate itself in this environment has been Hyperliquid. And their real breakout moment was after the start of the Iran war, when CME was closed on Saturday and everybody wanted to trade oil. So they picked up incredible volumes, and they take a little bit of a share of revenue. And just to give you an idea of how much revenue they're generating off of these contracts, trailing 30-day revenue is 75 million. So if we assume no growth, it runs at that rate for the next 12 months, we're looking at 900 million in revenue on a $17 billion circulating market cap. So we're looking at an 18.7 times forward multiple. And what's interesting is, I mean, the thing's had a decent amount of growth over the trailing 12 months. If it continues, it could grow at, another 20 to 50% clip over the next 12. So you'd be paying 15 to 12 times, 12 to 15 times forward earnings for Hyperliquid. I mean, and the thing is, I use revenue and earnings almost interchangeably because the thing operates at 99% margins or whatever. It's got 10 employees, and it takes most of the fees and buys back those tokens. So those are going right back. Those fees are going right back to token holders.
And just to kind of add fuel to the fire, I'm looking at Bitwise's Hyperliquid ETF. We've had these ETFs launch last month that kind of just, I think, accelerated a lot of this enthusiasm, the sentiment, and it officially crossed over 100 million, I think, last week. So it's great to see. I think despite the low vibes overall in the digital asset space and cryptos, we're seeing the names that have, I think, a fundamental product market fit catalyst that's, like you said, it has a valuation because of the fundamentals that actually is relatively, I would say, comparable to just like a normal plain Jane, large cap US equity company.
Yeah, even a
which is
little
something you,
cheaper at that valuation. I mean,
yeah,
if you look at the Mag 7, these things are trading in the 20s, sometimes 30 times earnings. I mean, so, and they're growing
yeah,
slower than this thing. So this is actually pretty cheap, all things considered.
growth at a reasonable price, right? So, no, it's definitely it's interesting to see the market. I think kind of differentiate that. I know Matt Hogan from Bitwise, I think tweeted out the other day. I liked it that the future of crypto is vibes, or I'm sorry, fundamentals, not vibes. So we're seeing kind of, I think, a lot of that different, kind of like singling out of the names that can kind of provide the stellar financial performance.
By the way, on the vibes front, I just want to point out that there's a real bifurcation or echo chamber effect that happens within crypto. Because when I talk to some of my friends who work in financial advisory, for example, they've had bids in IBIT in the low 30s that haven't been hit since February, and they're just keeping them there. And
Yeah.
from their vantage point, they're like allocating 2% of a portfolio to Bitcoin. It's down now to 1.5% mix. Their overall portfolio is doing fine, and they're trying to rebalance it back up. And so when I talk to people who allocate money, they're like completely unshaken by this whole situation. They're just more intrigued about all the negativity than anything else. And I'll just from a data perspective, that's interesting to think about. Bitcoin ETFs since launch, cumulative inflows right now is about $55 billion as of yesterday. And the peak was 63 in October 2025. So we've drawn down $8 billion. So it's less than, what is that, 1/7, 1/8 of the overall high water mark. And you're talking a 45%, close to 50, no, more than that, 50%
Yeah.
drawdown at this point. So is that like capitulation? I don't think so. I just think it's a commodity that's oversold on a daily basis over a longer stretch of time than it has before. But that's not really indicative of like a total market vibes collapse. I actually think it's just more the people who've historically been quote unquote over allocated and stretched who can't really participate when the asset's falling down because they're already fully allocated. Those are the ones that you're hearing the worst from, of course.
And there is a bit of like what you were saying with your anecdotal like conversations with the advisors talking about their bids not being hit yet. Look, we've seen how the price chart on Bitcoin's kind of played out. It's pretty clean technically from the market structure standpoint. The way we've seen it, first drawdown in October, respect the resistance zones, and then continue to draw down through February. And we've kind of took the staircase up, but we're now taking the elevator back down, which is kind of what we were expecting, unfortunately, as a base case. And you could kind of see when that it rejected the 200-day moving average, I think around 73,000. That was probably like a early signal that this was going to start to roll over sooner. It really is kind of this clean technical setup, and why I'm bringing this up is because when you have, I think, a lot of demand and appetite of orders being set lower, they see the previous low around 59,000, 60,000. They can be patient and they can try and wait and try and get into those opportunistic levels. And so what I'm looking for is exactly that, is to see, you kind of did it last night. I think we traded around 61,000, but you kind of trade back into those opportunistic zones, where we have a lot of demand, a lot of orders sitting, and see how the price reacts. I think I was checking the price around midnight last night Eastern time and saw that we were seeing like a nice V-shaped bounce on the 15-minute. So, people are starting to perhaps stick their neck out at this level. It's certainly, I think, an attractive relative asset class when you consider where it sits compared to its all-time highs and where equities currently are and where they're pricing in. You look at investment grade credit and spreads on that; those have kind of priced in, tremendous growth. Now we don't have any sort of any premium priced in for any slowdown or any risk there. So you kind of start to have to stick your neck out and look at places in the market where there's relative opportunity, and that's where I think Bitcoin might start to personally get a little bit more interesting here as we kind of trade lower. So and I think I just want to say, like, before we jump over from the hype topic, thanks Tomas, that was a really good point. We did just do our rebalances for our multi-token portfolios. The performance of Hype and I think the institutionalization of Hype, where it's been trading on more of our constituent exchanges, has allowed us to include it in our large cap portfolios. And Jen, I'm not sure if you want to jump in and perhaps give a breakdown of how Hype's being positioned across our indices.
Yeah, so for Hype, joining our large cap index is exactly the methodology doing its job. So for a bit of context, we have these capitalization series indices that are designed to capture like different percentage of the investable markets of crypto, and it's based on the free float market cap basis. So for Hype, for our large cap, it's built to capture roughly like 95% of the market. Hype joining it shows that, like we are at that benchmark that it is now one of the major tokens that could be captured within the basket. And it's also showing that like the supply is still unlocking. The free float is that actually there's like a sizable unlock, and it's just making it into our universe.
Yeah, that's great. Yeah, I think depending on the methodology, whether it's market cap, or like free float market cap, or using our diversified weighting schema, you end up with about 3 to 9% weight, depending on those types of capitalization methodology. So Hype is definitely something to kind of keep an eye out on. But Bitcoin, of course, still bearing the brunt. That's what we were just talking about. And Jen, I wanted to kind of bring you back in and talk a little bit about, not just at the surface level, which is price, but kind of what we're seeing underneath the surface and in the volatility space. So we've got our CME CF Bitcoin Volatility Index. And Jen, I was hoping maybe you could kind of give the audience a little bit of color on what we're seeing there, where we're seeing kind of premiums bid, insurance bid, where we're seeing risk appetite being bid, so we can get an idea.
Yeah, I think this is a really good time to talk about it. And coming back to Thomas' point, I think we are really seeing two kind of sentiments within the market, and you can read it just through like the volatility surface. We can see that the protection bid seems really concentrated at the front end and just below the spot. So if you look at the skew right now, I would say is like it has widened to somewhere near 10% toward the 10 delta puts, and the busier strikes have been like the 55K and the 70,000 K puts, which looks like there is a very legit and urgent demand for insurance. But there's also something that's very interesting, and like while looking at the screen, everyone has been paying up for the downside. Some of the block flows has actually come in from the other way, which is into the Bitcoin call spreads. So you could see that, like the hedgers are buying insurance below the markets, but there are also a lot of very opportunistic desks, or like desks which are like more strategically positioned in themselves to pick up the cheaper upside above it. And partly because the protection has gotten crowded, and our index, the Bitcoin Volatility Index, BVX, is one way to pull a lot of that into a very single and tradable level, and for you to just observe the overall sentiment of the market.
We're now, I think, at the point, this is a pretty big milestone where, talking about tradability, do you want to just highlight, I guess, a little bit about the recent announcement, the launch of CME BVI futures? How has the activity looked so far? What are some of the use cases for these products for practitioners, for industry participants? And maybe walk us through maybe like a hedging example of how we could use that in a portfolio of Bitcoin.
Yeah, definitely. I mean, like one thing I want to mention is that the BVI futures, it just launched a couple of days ago this week. So I wouldn't, like really look at the volumes, because liquidity in any contract tends to build over the month. But what's more interesting is right now is probably like the index itself. So like what we are looking at is around 50 right now, and it might, and for this year's data, like if you look at the trend of BVX, it has been fairly one-sided. On down days, for roughly every 1% of Bitcoin fall, the index tends to climb about 1.5 points. And on up days, it's been close to flat. And this asymmetry is something we just started to observe this year as the markets gets more sophisticated and gets more two-sided. And that's a big part of the appeal. And it's something tends to pay when you are under pressure without costing you much when you're not. So in terms of like one very simple but like workable hedging example, picture you are running a $10 million of Bitcoin and you like some protection against, let's say, a 20% drawdown. So based on this year 2026 moves, you would put on a long BVX overlay of just around a third of your notional. Then if Bitcoin were to fall 20%, if just investing in spot, you will be losing about 2 million on the coins. But at the same time, BVX is running from the high 30s into the low 60s, and it would have made back something very close to that. So you would have largely offset the move. And if the sell-off were worse, say 30%, you will be losing 3 million on Bitcoin, but the hedge would give back most of it. And on this year's relationship, if you're down only around like 1% on the whole book rather than 30. And also, like even if the dip is like milder, let's say 10%, the hedge would over deliver and you might come out marginally ahead. So one feature that's worth pointing out is that one single hedge of BVX can cover a fairly wide range of outcomes because the index response is convex and it tends to accelerate as the drawdown deepens. So on these numbers, like protecting against, let's say, a 30% move costs only moderately more notional than protecting against a 10% move. And that makes the deeper tail protection very efficient, which isn't always the case elsewhere. So, and also that's why, this year, I think it's particularly interesting to look at the hedging relationship between the vol itself and the broader spot market.
So that's excellent, Jen. Thank you for that. And on top of that, I think, we're starting to see, I think, for regulated U.S. institutions, a whole stack of price discovery and with a now a vol benchmark that, of course, is trading 24/7 around the clock. So once you've seen kind of, I think, this onshore movement with these regulated products, I think you're just going to get more and more institutionalization, a lot more activity of options desks using this like silver bullet type instrument for hedging Bitcoin price and Bitcoin price volatility going forward. So I don't know if there's anything else, Mark, that you want to add, or Jen, before we kind of start to kind of close things up as we head to the top of the hour.
Yeah, I was just going to say that these the vol futures also, in terms of unlock, there's the potential we could start to see some Bitcoin volatility ETNs trading out there in the coming months. So that'll give retail a little bit of access to trade these products as well. The VIX products have been
That's a
pretty
good point.
popular too, so we might see some activity there.
Yeah, that's definitely a good point. Keep an eye out for that. I think we've had a series of them either file or getting ready to file. I think we're gonna see more and more of that. Just as when you saw the VIX futures go live, the ETNs shortly then followed. So yeah, as we get close to the top of the hour, this is going to be our time for the show. We like to go around the table and kind of talk a little bit about what's top of mind. What are we keeping an eye out for the week ahead? So I'll let why don't you, Mark? Why don't you go first? I don't want to put John on the spot of since he's our guest, so we'll keep him on deck. But Mark, why don't you give us your take on what you're keeping an eye on for the week ahead?
Yeah, so for me, the number one thing top of mind week ahead is still any progress on the Clarity Act. It's made its way onto the Senate's calendar. That doesn't mean that it's going to hit the floor any specific time, but it means that it can be brought up. And there's been more and more noise around this from people in Congress and in the Senate and then the SEC and CFTC. So just anything on the regulatory front.
That would be a pretty nice catalyst if we could start to see that. I think it just got put on was it on the Senate's agenda?
Yeah, it's on the agenda now.
It's on the agenda now, so that's big. Definitely keep an eye on that. John, if you are ready to share, if not, I can also put Tomas maybe on the spot.
I'm ready to go if you want it.
All right, yeah, give it to us.
Yeah, I mean, I think Clarity is a good one. I guess I'll do the HPC AI piece. For us in particular, if we're just looking a week ahead, ERCOT, which is the Texas Energy Council, looking at that and seeing kind of who's going to get firm power approval. That is a big one for us, and hopefully we get that. It's not confirmed. I don't think that we'll have all the details we need next week, but hopefully in the month of June you get a lot more. And then the second component is just looking for lease catalysts, in particular WOOF. Management has indicated they expect to have another lease signed in Q2 26 here. So that is kind of coming up as well. And then there's a few other ones that have near-term lease catalysts too. So keeping an eye on those.
And so with earnings season on your space, is that pretty much wrapped up, or do you have a few more names to follow?
No, earnings is pretty much fully wrapped. In fact, all our names are wrapped. So we don't have anything necessarily earnings on coming up to bat, but these lease catalysts, they don't need to wait till earnings. And in fact, typical 8K disclosure rules say you need to put it out as soon as you have it, not actually sit on it till earnings. So still kind of a lot of catalysts before next earnings, and the big ones being the lease catalysts and then ERCOT.
Perfect. Awesome. Thanks. Tomas, why don't you give us what you're looking at from your seat?
Yeah, so I care about the Clarity Act, as Mark mentioned before. I care about the FOMC meeting that's coming up in a couple weeks. That's going to be Kevin Warsh's first FOMC. I'm assuming he's going to do a press conference, and so it'll be interesting to see how deliberations may have shifted. The complete wild card is whether we have any positive and or negative news on a day-to-day basis out of the conflict ongoing in the Middle East. And beyond that, I love this Jeff Gundlach quote. I forgot when he said it, but he said something along the lines of, I'll start buying bonds when they stop going down every single day. And I'm keeping a very close eye on Bitcoin ETF flows and this upcoming capital markets distribution with the SpaceX IPO. I have a gut feeling that people are building a lot of dry powder and they're going to have a lot of disappointment when they see how little allocation they got. And they're going to have to put that money back to work somewhere. So
That's a good point.
I'm being very watchful for that as well.
Thanks for that, Jeff Gundlach, Chloe. I mean, if I kind of forgot about the Bond King drama that used to kind of ensue the headlines of capital markets. So that's a goodie. Certainly, in this environment, when you get these commodity shocks, it brings that 60-40 into question, where we're getting the some risk off in the bond markets as well, with rates rising. Shin, what's on your horizon? What are you keeping an eye on?
Yeah, I think, aside from looking at how our Volt index is performing, I think one really important or interesting thing to look at is the front June expiry. Because right now, like we see a lot of analysis pointing to the max pain region at the mid to high 70K area. So I guess we are just looking to see, if the spot is gravitating towards that max pain, or is, the positioning is creating a squeeze away from it. And this also matters, like, to tell us like how the dealers are doing. Like, are they either trying to stabilizing, or are they trying to short gamma and amplifying the moves?
Definitely worth keeping an eye on that, all those technicals that you get with the dealer positioning. My one thing, and I'm surprised no one brought this up yet, so thank you guys for this layup, but I'm going to keep an eye on Friday's payrolls. I think the Fed obviously is going to be paying close attention to see kind of like how the labor market's developing, how it's holding up. We saw the JOLTS number surprise the upside, but I think we should take that with a grain of salt. That was pretty concentrated in, I think, one specific category of the economy. We're still seeing quit rates pretty low, along with consistent wage growth that's followed. So the labor market's kind of giving us a bit of mixed signals, but with the ADP number coming in stronger yesterday, I wouldn't be surprised that perhaps maybe the NFP report follows that and echoes that, and that will cause, I think, that could cause a lot of disruption, I think, in the futures pricing for for Fed moves. It could cause a lot of disruption there in the front of the curve if you see a strong number. In this case, we might be getting a bit of like bad news is good news if we get a softer NFP print where the talk of rate hikes could start to die down a bit, and that would be a nice catalyst, I think, for some of the more duration sensitive assets that we see here in the crypto space. So that's the one thing that I'm keeping an eye on. And I think all the other ones were really excellent. I want to thank everyone on this call for participating on another awesome dialogue. I really enjoy it. So I really appreciate everybody's efforts. It's always a great time to get together and talk markets. With that, be sure to tune in, follow along with our research, all of our content we produce at CF Benchmarks. Our weekly index highlights comes out on Mondays. Mark's going to be publishing the Factor Fridays tomorrow, where we talk about all of our factor performance. And we just published our monthly market review for May, so be sure to check that out. And until next time, we'll be in touch. Everybody trade safe, and thanks again.
Thank you.